All right. Welcome back to Inventory Watch. It is October 1st, and that means that we have a full month of data to kind of chat about, and I wanted to go over this stuff with you guys. Let me see if I can get into presentation mode here. It's a little bit late today. I apologize. If you get migraines, let me know in the comments. God, I had a doozy earlier today. I've had at least one a week, every week for the past 3 weeks, and it's just been killing my mojo. So I went to the doctor on Friday, and they said that could be like allergy, sinus related, and anyway, so if you have any tips for me, like put them in the comments. But anyway, so full month of data. It's October 1st, so that means I've got all full September data to compare and see and get all of it. I usually do weekly updates, and at the end of the month or the beginning of the next month, I usually do a full overview of the month previous. So let's see what we got. So I want to talk about new listings right away. I talked about this last week that we were kind of in it, like we've had this huge rush of inventory. Inventory was up 35% in August, but as you can see, there was not new listings. There wasn't 35% new listings coming to the market. We actually saw the same amount of inventory in August that we did in September, and we didn't see this big rush of inventory continue to come. Inventory is actually up 7% in September, but inventory was definitely not up 7%. So I do want to talk about the reasons why we have such low supply in our market. Our market is, again, real estate. It's supply and it's demand. So we have a supply side and we have a demand side, and they're both really low right now. And I have 4 reasons up here on why we're in a super low inventory market. The first reason is because we have unbuilt inventory, and I have a graph to show you around that. The second reason is institutional inventory, and institutional investors started buying in our market during the Great Recession, during the last housing downfall, and they started buying up the short sales or foreclosures, and they basically never stopped. They've been purchasing ever since. They found that managing rental properties was actually pretty lucrative, and so they became an institutional property manager, basically. And that brings us to build to rent communities, and I have another chart for that, of course. And then we have personal rentals and Airbnb inventory. Total rental inventory in our market, 26% of the homes in our market are straight up going to renters, or rental type homes, right? So people are not living them as their primary residence. 26% of them are for rental purposes. So that's personal renters, somebody like you and me, like renting out a second home, institutional investors, and like Airbnb type rentals. In the market right now, we have almost 12,000 Airbnb listings around Phoenix, which is a lot of homes, right? 12,000 right off the bat. And in the past couple of weeks, like I talked about, the institutional inventory, and Progress Residential has between 8,000 and 9,000 homes. Invitation has between 8,000 and 9,000 homes, right? And so that's another 16,000 to 18,000 inventory on top of just 12,000 homes that are just like gone out and, to rentals. And so there's a lot of inventory there. And plus there are some smaller institutional investors as well, people that I haven't been tracking. And then we have the other people like myself. I fall into this category. I'm one of those people who are locked into a low rate on my mortgage. And so there are people like me that I don't want to sell my house because I don't want to exchange cheap money for expensive money, right? The house has to be really, really good in order for me to want to pay that more for it. And right now I'm just happy like where I'm at. So there's a lot of people that are in kind of my situation. And so fundamentally we have super low inventory, and I want to talk about that fundamental shift in our market, because I think it's something that you guys, we need to start thinking about, this critical lack of inventory. I mean, it's critical, and it's long term. It's been happening for a while. And let me just take you to this graph. So the supply shortage, this is a graph specifically for Maricopa County. And you can see it's by decade, right? So we have like in the 50s, they were building, I don't know if this is 100,000 or if this is by thousands. But you can see like it was less than 100,000, right? And then it was almost 150. And then boom, there was this big boom, right, in the 70s, and we were close to 300,000. And then in the 80s, we were around 300,000, right? And we hit 350 in the 90s, and boom, straight up to over 400,000 in the early 2000s, the late 2000s, with the other housing downturn that we saw, that inventory coming to the market. Well, guess what, guys? We are in a bubble kind of housing right now, but we don't have this. We don't have new construction that is leading the pack this time. They actually stopped building between 2010 and 2020. We didn't see any new construction coming to the market. And this is 2020 to 2023. Like, you can't even see the line here. So we've been historically, like, if we were to put a median on this, right, to put like an average level, we are still below the average level of new construction that needs to come to the market for us to continue to grow our supply side of things. So I think this is really important to understand, that this is specifically, this chart is Maricopa County, but if we look at this across the nation, it's not just here. Almost every county saw the same thing. So this is a fundamental shift in new construction that happened. It was done on purpose, and I'll try and find some more data around that and like tying this stuff together. But fundamentally, we are in a short supply because the powers that be didn't want to build the homes. End of story. And whether it's lumber shortage or whatever's happening there, I'll get to the bottom of it. We'll get some more data for it. But this is where we're at now. Okay. So fundamental supply issues that over the past 10 years, or now we're 2023 going into 2024. So over the last 14 years, we have not had enough homes being built around Maricopa County to keep up for the influx of people moving into Maricopa County. Governor Ducey put a lot of tax incentives. He brought a lot of business here, a lot of people moving here, and we just simply did not have the housing demand, which is why they're building apartments like gangbusters here, right? To keep up, people got to live somewhere, and so they're building apartments. And the other thing that they're building are build to rent communities. And I want to talk about that. I have a graph for build to rent, but I think I have one more before that one. We'll go right into build to rent. So build to rent communities, if I move the little bubble, you can see that this is from Harvard University Joint Center for Housing Studies. This is single family build to rent hit records high in 2022. And so you can see this line went just straight up. Like, it didn't do a thing. Like, it just went straight up. Basically from 2020 to 2022, we saw just this increase in single family homes that were being built for the sole purpose of just renting out. These homes never hit the market. They're not planning on hitting the market. This is a fundamental shift in how builders are building. We are not getting them. They're not coming to the supply side to feed everyday Americans to purchase homes. It's just not happening anymore. And so it's something that we need to be aware of, especially as a homeowner. Somebody who owns homes, like, this makes me never want to sell my home, because I don't feel like my children will have the same legacy opportunities I did of being a homeowner and building wealth through homeownership and having that stability for my family. So something to think about. It really, even though it's so expensive to purchase right now, it's really making me think twice about owning another home and like trying to see if I can own another home to build something to pass down to my children. I have three, I have three kids. So like, I don't, I want to make sure that each one of them has the opportunity to have a stability in housing. So it's something that I'm thinking about when I'm planning my legacy. And I think we all kind of need to think about that stuff. This is from a video I did a couple years ago in 2021 saying like, or 2020, like, hey guys, like as we go into 2021, we need to keep track of BTR. We need to keep track of this. This is a slide from that video. I'll post it somewhere up here so that you guys can watch that one if you want to, because I go into detail about BTR and new construction and about this trend a few years ago. So just as a reminder, Lennar and D.R. Horton and many other players in the market have added this model to their business plans. And and back in 2020, Lennar had committed $4 billion to ramp up that model in their business plan. And so I think that's something that's very significant, when in fact, and I'll tell you this, I did buy last year, I bought a reverse ETF on the stock market that anytime the housing market, if housing stocks were to go down, that price of the ETF would go up. And so I would make money in fact, when the housing market declined. And in fact, I bought that and the housing like pricing and all the builder stocks actually went up and the ETF went down. Just recently did it have this kind of like boom tick up where I kind of broke even. I think it's up a little bit, but I might consider selling it, knowing and like remembering that all of these companies did buy into this rental market. And it's October 2023. And if you Google Warren Buffett and D.R. Horton, like you'll see in the news that he just bought like $30 million worth of D.R. Horton, I believe, or one of the big builders he bought into their stock market. And I'm thinking, or into their stocks. And I'm thinking like, that was odd. But, just remembering that they invested all of this money in this build to rent model, like they must know something else that we don't. So something to consider there. Back in 2020, I called this institutional investor mania, where we saw these were all of the players who were, financing properties, right? Let's see if we look really, really close. I don't have my glasses on, but like you can see like all the people who were providing capital, and then you can see all the people who were, managing the properties, right? And I talked about Progress Homes a couple of weeks ago. I talked about Invitation Homes. They're both here in our Phoenix market, managing these institutional investor properties. And like I said, like just those two companies have between 16 and 18,000 homes that they manage here in Phoenix Metro. So build to rent developers, you can see D.R. Horton is right here. They're one of them. Lennar Homes. Who else is on there that we might know? Greystar, Global City, just a bunch of people. Anyway, like I'll put a link to that video so I go into this in a little bit more detail. But again, I think fundamentally, if we go back and we look at the data, like inventory every single year just consistently falls, and it gets lower and lower and lower and lower. And this year is no exception. Even with like the 34% increase in inventory that we saw last month, like we're still historically low, and critically low. And I think as we move forward, like as much as I would love to see home prices come down and affordable for buyers, I just don't know where this inventory is going to come from to make that happen. Like we still need more inventory to see prices come down to an affordable level for home buyers. So if we look at like the prices, we'll look at the data. I think that's next. But I think as we look at that, like when we remember, like those of us who remember 2008, right? We think like, oh, home prices came down like 60%. In order for that to happen, Like we need way more inventory that we have now. And I'm just like, I'm not seeing it, at least not in the numbers right yet. Where it could come from, we could get inventory. And I said this last week that there are people who are relying on their credit cards more, right? And so those are what I call forced equity sales, people who need to sell to pay off debt. And so I think that we'll start to see more of that happening as people, rely on their credit cards to maintain the lifestyle that they had pre all of this inflation, right? And I mentioned it last week too. Box of goldfish crackers, like, the giant box, because we have an autistic child that loves the goldfish and cheesy crackers, and like she needs her cheesy crackers, and like it went from $6.99 a box to like $10, over $10 a box. And like, how can you afford that? And that's just 40% increase. That's just it's a lot. And it's not just on crackers, it's like everything has gone up. So and so like I'm looking at ways and cutting back and cutting my budget, figuring out like what can I make at home and what can I do to get my costs down here, because that's the only way to get through inflation, is to really to cut back or to make more money, right? And so that's the other way you can do it too: get a second job, get a side hustle. Or you spend on your credit cards, right? And unfortunately, people do that, and it leads to possibly having to sell the only asset that you have. And again, knowing where inventory is, if I were to get into major credit card debt and have to sell a house, I would cry, because like I don't know if, like, knowing what I know, looking at these numbers, I do not know if I would be able to afford to buy another home or to have that opportunity the way I did, and to have that equity that's in there now. Like, I think equity might be building a lot slower, and actually we're in negative equity, like negative growth right now. So let's talk about the numbers. And so I'll stop telling you what to do with your money. Don't put things on your credit card. But total active inventory in Phoenix, I didn't update that from last week, but we're at 15,005 something, and it went up slightly from last week. So we're still over 15,500 homes on the market right now. And we've got August. So this is a full month, month over month. So we have 35% increase in August and only a 7% increase in September. And I talked about this last week, where the reason why is because in August, we saw the interest rates jump so much higher. We had that big push from like 6.8 and it went to like 7.4, 7.5 or something like really incredible, like in August, and the buyers just fled the market. That was the end of the buyers for the summer. They were like, oh, I'm out. And they kind of left the market, which meant that inventory it grew, not because we had new listings, because we're still very supply constraint here, but because the houses just are sitting on the market because the buyers aren't there. Same thing with September. We saw inventory just go up barely 7% because the buyers that are left in the market, avoided the fallout from August. Now, if we see interest rates go up over 8%, we will see the rise again. Like, if we see that in October, we could probably see like another rush of like inventory come to the market, but it's just more of like home sitting. We'll probably lose more buyers if we get over 8%, because it's like another level of buyers will be like, oh, I'm tapped out, I can't do it. So it's going to force another level of buyers out. As you can see, the average list price was 802 in August, and the average list price in September was 787. So that came down quite a bit. You can see where home sellers are listing their homes for and what they're actually selling for are two completely different numbers. So let's take a look at that. Sold inventory, if we look at that price, was 7 something, and now like what they're actually selling for is 546. So what home sellers are listing for is just not anywhere close to what buyers can afford right now. So understanding that the average price is 546 for September for about 1,800 square feet. And you could see that in August, we had a 10% decline in buyers. So 10% of the buyers left the market in closings, and we saw them completely vanish out of the market. And I've been talking about that for the past few weeks. Let's look at pending inventory, because again, pendings are what tells our future, right? So solds tell us what happened the month prior. And we had like, over 4,000 sold. But for September, pendings were only at 3,588. So that means that is also down another 10%. So which means that in October, we're going to see another 10% fall in closings. So that would give us 20% for 2 months. If that comes to be at the end of October, if we're here, the end of October, we see another 10% drop, like that's really significant in the amount of buyers just like exiting the market. The average pending price though hasn't changed a whole lot. We were at 566 in August. We're at 561 in September, and it's not much different than what was sold prior. And so we're seeing this kind of holds steady here. I believe it sold for 540. So we're pending at 560, but the solds were like 540-ish. And so we're actually seeing about $20,000 be negotiated off of the price of the homes, if that's what we're pending for, and we're closing for $20,000 less. So there's negotiation happening in our market, like for sure. Sellers are buying down interest rates. They're doing anything they can to get their home sold. They're working with the buyers and they're fixing things. And it's so much different than it was last year, where sellers would just put their home in the market and be like, it's as is, like, give me your highest and best, right? That's not happening anymore. So sellers are willing to negotiate now, and it's good for home buyers. It's more healthy. Let's talk about rentals, because I feel like this is very interesting, especially with all of that build to rent communities happening. I didn't even go into the build to rent communities, right? Here in the Phoenix Metro, like I saw one out in Queen Creek. I saw one up I-17. There's another one being built down here by the Raven Golf Course in South Phoenix. And these communities are popping up all over Phoenix with build to rent. So these are those communities I was just talking about, where they're building the homes and they're going straight on the market to rent. They're not being offered for sale. They're just straight up rentals, and people were renting them or not. We're going to talk about it. So new rental listings coming to the market is actually slowed down as well. Again, there's no new inventory coming to the market. It's actually down about 1%, about 150 homes. In August, we had 3,500. In September, we had 3,300 rentals, like brand new rentals coming to the market. And so that inventory is also slightly down, just like new listing for sale inventory was slightly down. But I think the most interesting thing here is not on the sold slide, is actually on the pending slide of where demand is. So the supply side, I didn't even talk about supply side. I didn't even put that in the graph. So supply side is also up, just like home selling inventory is up. We saw like a 33% increase in rentals in the market in August, and a slightly higher, or a slightly more inventory in September. So very similar to the trend that we saw with new home buildings. And so we did see like total rental inventory increase, even though there's not any brand new listings really hitting the market comparatively. It is still because demand is still so low that we're seeing rental inventory start to stack up. So this actually isn't a huge decrease in closings. So we had 2,585 versus 2,529. But we're going to see it in the October numbers for sure by looking at the pendings. What is notable though is that renters actually said, no, I'm not paying almost $2,500 for rent. And we did see rent come down to $2,374 in September, which is interesting. So, because when we go look at the future, let's look at the pendings. So here's the pendings. Looking into the future, the month end for September, the average pending price in September was $22.77. So down another $100 in what was actually being offered under contract versus what actually closed, right? So this is going to tell our future of where rents are going to be on October, which is really interesting. And look at the difference between how many went pending in August versus how many went pending in September. So 1,600 in September. Only 1,600 renters said, yeah, I'll rent. Just blowing my mind that the fact that renters and buyers have been boycotting this market, and it's so wild. A 33% decrease in renters in September, and I'm shocked that actually rents only went down $100 in the pending prices. I think that we're going to see rents continue to come down, and I think that if you're looking to buy or rent in this market, that there's going to be some great deals for you. If you're looking at an apartment, I talked about last week how I saw like 8 weeks free rent with one of the Mark Taylor properties in Goodyear. And I think a lot of apartment complexes are starting to do that kind of thing and offer incentives to renters, as it has slowed down considerably in both, single family rentals and apartment rentals. I think we're seeing the same thing. So, if you can afford the 7% interest rate and you are looking to buy, understand that negotiation is your friend right now. If you don't have a real estate agent, they can be your voice and help you negotiate and win some concessions for your purchase or your rental. So think about that as you move forward there. And then I do want to end by showing you guys the last thing. If you guys are looking to sell your home, make sure that you get a sold score for your home. I'll show you what it is. It's something that I created. It's a great tool to help you understand how saleable your house will be in this market, because in some markets in Phoenix, things are still kind of selling a little bit quicker than other markets. And if you don't know which one your neighborhood or your home is in, get a sold score, because if your home scores over 50, it's more likely to sell in this market. So all you have to do is come to mysoldscore.com. You come in and click get started, and the little bear is going to say hey, let's get your sold score. And you're going to hit get started again and just put in your address right here. It's going to calculate a score. And again, if your score is over 50, it's more likely to sell in this market. If it's under 50, then there's some things that you can do to optimize it to make it more saleable, make sure your curb appeal is good and things like that. Always work with your real estate agent to help them, they can help you optimize your sold score and get it up so that it's higher if you're going to go to market. So that's all I got for you guys. Thanks for watching, and we will see you next week.